Hello and welcome back, small business owners, and thank you for tuning in to the Small Business Tax Savings Podcast. My name is Mike Jesowshek. I'm a CPA and founder at JETRO, which is a digital accounting firm servicing small business owners exclusively around the country. We assist with accounting, bookkeeping, taxes, and payroll. On today's show, we have a very special guest, Bill Moeller. Bill is a mortgage lender at First Bank and has been specializing in mortgage lending since March of 2000. It is his mission to match clients up with a program that fits their individual circumstances. Whether a client is looking to purchase their first home, build a new home, or buy before they sell, Bill will map out several scenarios to ensure that every client is making an informed decision. His favorite thing about being a mortgage lender is educating people on how a mortgage can be used as an effective tool towards their short and long-term financial goals. Bill resides in Waukesha, Wisconsin with his wife, daughter, and son. And in his spare time, he enjoys cycling, fitness, and auto racing. Bill, welcome to the show.
Thanks, Mike. Thanks for having me. I appreciate it.
Yeah, and I'm really excited to have you on the show just for the fact of we've known each other for quite some time now, and a lot of times when I meet or when you think of a mortgage lender, things like that, sometimes you think sly or not something, you sometimes think good things don't come to mind. And one thing that I really like about working with you and knowing you is that you're out there to help other people. And so you do your day job and you help people, get people mortgages, but you go above and beyond. And so it's not just doing mortgages, but you're helping people, educate people. And I think that's why I really wanted you on the show and think that you're going to be, a great asset to our listeners today. So I definitely appreciate that. And it comes out in the work that you do. It shows that you definitely care for others and out there to help people. So
I appreciate that, Mike. The thing with our industry is that the experience that consumers have for how they take out a mortgage today is more different than it's ever been. Mortgage companies have a process that they want to follow now that's more done over the computer, and it takes a lot of the touch out of the process. When you think of the Rocket and you think of the notion that you should get a mortgage on your cell phone, and quite honestly, that just doesn't lead to a confident outcome for the consumer. That's why still being able to get belly to belly with the customer and go through all the things that matter to them, that's really at the center of how I try to run my practice with my business, and making sure that people understand when they're going to lock an interest rate or choose a certain loan program, or ask some basic questions like how long you're going to be in the property, or what is your short, like I said, or like you pointed out, the short and long-term financial goals. I have some clients that make their first property purchase a duplex so that they can start making some long-term financial decisions that will, allow them to have passive income one day, which, being able to delve into all those things with you here today is definitely going to be part of our focus.
Yeah, no, that's awesome. So to get started, I just kind of want to warm our audience up a little bit about what we're going to be talking about today and yourself. So we're going to go through 4 quick fire intro questions. So the first one is, why do you do what you do?
So the reason why I do what I do is I've always been interested in numbers, and I knew that from an early age. I actually started as a finance manager in the car business when I was 23 and a half years old. And when I decided that it was time to get into the mortgage industry, I hadn't even owned a home yet. So I basically have a passion for really, really giving back to people in a way that I feel is meaningful and tangible. Having a chance to get people into a spot where they're going to be confident about what is their largest financial obligation and how that relates to the fact that it's either starting a new chapter for someone in their life or allowing them to realize more wealth. That's really what makes me feel, that's my why for the reason why I get up and come in and do this every day, even though the process has so many separate intricacies that, I kind of joke around. I have a suitcase in the back of my office here with all the different hats that I need to wear. But it's something that I feel good about based on all those things.
Yeah, no, that's awesome. What's one ritual that you do that helps you become better at what you do?
So I'm a big runner, and I listen to a lot of subject matter experts in the mortgage industry that are in the top 1% in the country. There's some coaching groups and things that basically I'm looking at ways that I can always fine tune what we're doing to optimize the mortgage payment for the customer. When is it time for us to take a different approach based on the loan products that are available? Because in our industry, there are so many loan programs and so many overlays. So basically, I carve out at least 1 hour a week just to delve into those kind of things, because in our industry, you have so many different options that you can take on that if you don't pare them down ahead of meeting with people, you just can't provide them with the most relevant and accurate feedback that they need.
No, that's great, and I think that within any industry, there's always moving parts, and so if you have two options. You can kind of sit and continue doing what you're doing and don't really care about the things that are changing, or you can make an attempt to learn things that are changing and kind of use that to your advantage. So that's definitely huge. The same thing within the accounting industry and almost any industry. Is staying on top is definitely going to help you be
We
better.
also do a lot with the realtor stuff too. A lot of times you'd be surprised when someone is going to buy a property and they're working with a realtor that maybe isn't acting in their best interest. Having a hand in understanding what the rules are regarding real estate contracts, regarding home inspection process and all of those things, those are all things that we need to be familiar with too, because you just never know what you're going to encounter regarding the customer experience and how that can play into the financing.
Yeah, no, that makes sense. What is one app or system that you use to stay in control of your workload?
So we have a couple of different tools that we use to stay in control of our workload, but one of them is our loan origination software, and that's put out through a company called LLC. It's called Encompass. And within Encompass, I can run reports based on my deadlines in the real estate contracts. I can run reports based on when appraisals are going to be due. And then finally, if we have situations where we're missing documents, a lot of those reports can be pulled right from that system. The thing with us is if we pass a deadline in the contract, our business partners expect us to know those deadlines and expect that we're watching those deadlines for ourselves, because if we don't meet certain deadlines regarding appraisals and regarding like the commitment for financing, we can actually cause a deal to go sideways where the seller can actually issue a mutual release, or the buyer might not be able to have their appraised value be a consideration in whether or not they proceed. So we have to monitor all of those things. So it's a system really that's more centric to the mortgage industry than it is to the consumer. But just knowing that you have a lender that pays attention to those things, that's what's most important. So the system, again, it's called Encompass.
That's great. And, there's two main topics that we're going to be talking about today. And the main topic I want to discuss is kind of self-employed income. Most of our listeners are small business owners or will be small business owners in the near future. And a lot of times that's the biggest question when you are a self-employed business owner. How does that affect your ability to get a mortgage for a house? And so that's kind of where we want to spend a lot of our time on. But
Sure.
Before we get into that, I want to talk about rental properties and real estate, because we had someone on our podcast a couple weeks ago that we talked about the option of adding a rental property into into your lifestyle as a passive way of getting some income in. And being with business owners, there's oftentimes a lot of business owners that want to get that extra revenue source or get a different separate revenue source from their main business. And so I want to talk first about a little bit on rental properties, just to kind of marry that with our previous episode, and then we're going to dive deep into that self-employment income. So just to get started kind of on rental properties, give me a little bit of an overview about buying a rental property and using a mortgage and how that works as far as someone that's looking to get into real estate, how that would look getting a mortgage on that side.
Okay, so first thing we're going to mention is, as it relates to the type of properties, let's first define what's considered a residential mortgage application for a rental property, and that's going to be a 1 to 4 unit property. So anything over 4 units is considered commercial. The next thing to take into consideration is in the scenario where you have someone that wants to purchase their first rental property, we'll just delve into how you arrive at the minimum down payment requirements, the fact that there are some reserve requirements, and then we'll also factor in how we arrive at qualifying for that rental property. And I'm going to break it down into a couple really simple bullet points. So you can purchase a single family rental property or a condominium with as little as 15% down. And most people don't realize that, but Fannie Mae actually, not Freddie Mac, but her little brother, Fannie Mae, sister, I should have said, Fannie allows you to do just 15% down for a single family or a condo, and but that has to be your own funds. So when you go down that path, we call seasoned funds money that's been in your bank account for at least 60 days. So when you purchase the property, take into consideration that you can't use gifts or monies from an outside source as far as they're concerned. It has to all be your money. And then the next thing to keep in mind about that is as it relates to income. So let's say that the proportion of your debts and your income are at a place where you don't have a lot of room left over in your affordability based on your income calculations for you to qualify for that payment. So what we'll do then is we'll take 75% of the gross rents and we'll add them back to income for the subject property, the one that you're purchasing, and we'll allow you to add that back to income so that you can offset that new mortgage payment.
Okay.
Now, if there's a tenant in the property, we're going to use the rents from the tenant that's in the property. But if there isn't a tenant in the property, we're going to have the appraiser do a rental income schedule that's right inside the appraisal report, where they're going to survey the landscape for other properties in the area that, to see what the common rents are in that market. If you have someone that's trying to use a higher rental income projection to qualify them with the market would bear, that could be a question that would come up later when they're applying for financing.
Got it. Makes sense.
And then the final attribute to this would be the type of properties that you're looking at. We've had some instances where we get inquiries for mixed use properties. We've had some cases where people are trying to purchase a property that definitely is zoned commercial. And we find that people looking for properties that are either mixed use or commercial, that they're going to need to go through a commercial lending channel, which might require some more down payment and might also not allow them to get the traditional fixed rate products that you would associate with Fannie Mae or Freddie Mac, because Fannie Mae and Freddie Mac do not have an appetite for mixed use properties or for commercial properties.
God, so that would be an example. Let's say you have a bar or something like that on the lower level with an apartment on top. That would be an example of that.
Very good example. Yep.
Interesting.
Yeah, and you can see how the properties are zoned also. It has to do with, there's a lot of different aspects to how a commercial dwelling is underwritten versus residential, because you might be looking at the cash flow of the business that's inside that rental property as a basis for the credit decision. And when we're doing those transactions, we're just looking at the profitability from a rental income cash flow standpoint, as opposed to like what type of cash flow would come from any certain type of business that might be operating in that dwelling or in that building.
Yeah, that makes total sense. So when you're, what type of properties would qualify for residential financing? Is it just anything, is that the only piece that would not qualify for a residential financing, or what type of properties do qualify?
So, the best examples I can give you is if you're in an area that's got a high presence of residential homes, where there's, let's say you have a situation where there's a lot of 4-unit properties in one certain area, densely populated with a common type of property. That's going to be the easiest ones to get done. And the reason why I say that, Mike, is really simple. The mortgage company wants to make sure that they can base the appraisal around reasonable market comparables based on, like style properties in that area so that they can establish the value. So typically what we're seeing in cases like these, the majority of the people are buying 2 to 4 unit properties. And I did make the comment about the 15% down for condo and single family, but I didn't finish that thought. The 2 to 4 unit properties are typically going to require 25% down. And then the other aspect of this that's really important to keep in mind is you need to have 6 months reserves for the subject property that you're purchasing in order for you to qualify to purchase that property. And you can use retirement account assets to meet those reserve requirements. So if you had like a 401k or an IRA, stocks or bonds, etc., we can use those statements to document those reserves, and we don't have to rely on liquid assets for those. Those are the key components to making that product in the process of getting the rental income predictable outcome for someone looking to get into that.
So if it's a single family rental, you're looking at probably 15% on the lowest side. But if it's a duplex or 2 to 4 or anything higher than that, then it's about 25% of the down payment is general standards.
Yeah, I have seen some portfolio lenders out there in the local marketplace that are doing less than 25% down. but there again, you're not going to get those competitive terms. We are seeing people with looking for 30-year fixed rate money with no discount points today, right now, that are idling on those properties somewhere between 4.75% and 5% as of the time that we're recording this message. The thing is that there are what we call delivery charges, also known as loan level price adjustments, that are applicable to rental properties. So if someone wants to get the very lowest interest rate for their mortgage, like you would expect if you were buying a primary residence, you would need to pay discount points to get to that rate. And that's common across the industry that those surcharges exist.
Got it. Now, what if someone, already has another property and they want to use some of the equity in that property to purchase or, put a down payment down on another rental property? How would that type of system work, and is that possible?
So yeah, they've got a two-part answer to that. The first part to the answer is you can go up to 75% loan to value for a cash out refinance. And basically the 75% loan to value, let's just say in simple math, we were going to take a scenario where we had a $100,000 rental property and you've owned that for a little while. You'd be able to basically take 75% or $75,000 less your current mortgage balance, and you'd be able to get the rest of that money out in cash.
Okay.
Otherwise, the second thing that you would do is you would look to see if you could obtain the funds another way, and that would possibly be through getting like a home equity line of credit on that property. Sometimes we'll also see people use their primary residence as a means for getting money out for the rental property down payment if needed also. And only other thing that I was going to say regarding this scenario is you typically associate with a higher loan to value position on residential owner occupied homes than you do on non-owner occupied homes. So like for me, as an example, one of the things that we'll do at First Bank Financial Center is we will actually do a cash out refinance up to 90% of the value of your current home on a first mortgage. And that's pretty exclusive in this area. So keeping in mind that the normal guideline is up to 80% loan to value for someone doing a cash out on a primary residence, you might wonder why I would suggest going up that high, but especially if you were going to have mortgage insurance over 80%. The thing is that if you were going to get a home equity line of credit that's going to be tied to a rate that can go up or down, you would find someone in a spot where the blended interest rate between a first mortgage and a home equity line would end up being higher at the end of the day. Yes. So we're looking at ways, all kinds of ways, we're surveying the landscape with the customer around what are the best ways for them to try and put those funds together. Another thing I might find is I said this is going to be a two-part response. What if you bought the property at a good price, and based on what you could get it to appraise for now, you might be able to get more cash out? So that's where we're going to try and work with someone that understands the comparables in the marketplace and what was a good buy and what's the best property to get the cash out from in terms of what they have available to them in the way of the value of what they've got.
Mm-hmm. No, that makes sense. Now, and this is probably something that you see happen more often from lawyers, but when people start to buy rental properties, a lawyer will often say, put every rental property in a different LLC and run it that way. And the idea behind that's fine, but what often people have troubles doing is they have this brand new LLC that's got no credit, no nothing, and they say, well, how can I get a mortgage under that LLC? So what is a workaround, or how do you see people do that if they buy a property, whether they're paying for it personally? How do they end up getting that to be listed in an LLC?
Hang on one second. Let me see if my underwriter is anywhere nearby before I answer your question. You gotta be careful on that one. Basically, there's two trains of thought with the notion that you're titling a property in an LLC. First of all, the covenants in the mortgage stipulate that you are, as the borrower, you are the one who's obligated to repay, and that you're going to remain in title on the mortgage. The document that you're signing stipulates that you're going to remain in title on that mortgage if you're applying for a residential, non-owner occupied mortgage. Mm-hmm. Now, there are some trains of thought that I'm not endorsing by sharing this, basically that say that there are no checks and balances at the Register of Deeds that stipulate the notion that we're going to tell the lender if you title that property out of your personal name, like so Mary and John Smith changed it from their personal names to Mary and John Smith LLC. So they do something where we do what we call a quit claim deed, where we take the property, we deed it out of their individual names into the LLC, and that happens shortly after they close on the property so that they could get that set up. Now going back to what your comment was about, let's say the LLC doesn't have a lot of assets, and that's just it. For a mortgage company on the residential side to foreclose on an LLC, the thing is that what assets really exist in that LLC? If it's just that one property, we actually don't have a vehicle or a tool within Fannie Mae and Freddie Mac's policies that allow us to ask an individual to guarantee that loan. So you have to go into the LLC after closing, and if you do that, you are theoretically violating the covenants of a mortgage. Or the second thing you have to do is go and just get a commercial loan where the commercial mortgage company will allow you to do that LLC as the borrower instead of the individual as the borrower. So we do see a lot of instances where people will title the properties in their LLC. If I was just going to try and tie this all together, people title it in the LLC after they close on the residential loan. And then if they ever want to go do anything with the mortgage after that, they will then go ahead and title it back in their personal name if they were going to go and seek out residential mortgage financing for that property again later.
No, that makes sense. And I think that a lot of times it's not necessarily to, most people that put it in an LLC are not for the fact to avoid paying a mortgage or, a foreclosure down the road. It's that protection. So that's a good point.
Yeah, I just needed to make sure that everyone understands and that's hearing this recording that we're not condoning violating the covenants of the mortgage.
Yeah, no, that's definitely a good disclaimer to put in there.
Yeah.
Okay, so I think that's a good introduction for those of you that are listening. I think that's very helpful to hear about some of those options on the rental property side to kind of match with the passive real estate investing podcast episode we did earlier. So if you haven't listened to that real estate episode and you're possibly interested in getting into rental properties, check that one out first and then, come back and re-listen to what Bill just shared with us here. But what I really want to do is dive into that self-employed income as I mentioned in the beginning. I think that a lot of business owners just get scared when they become business owners because they feel like now we can't buy a house, or they want to stay in a W-2 job or stay as an employee so that they can get their house and then they'll start their business. And, that's not always the case. And I want to kind of pick your brain a little bit to understand a little bit about what it means when a small business owner tries to get a loan. So the first part is does it matter if they're set up as a sole proprietor, on a Schedule C, a single member LLC that's all being on the Schedule C, or if they're set up as an SCorp, a C-Corp? How does those two differences affect getting that mortgage for a home?
So there are some parallels, but there are also definitely some differences in the two. So when we look at the LLC scenario first, the sole proprietor LLC, or where you have a scenario where you're running off of a Schedule C on your tax return, the mortgage company is basically going to use a form that allows us to start with the net income. Then we have certain things that we can add back to the income. So let's say that net income at the end of the day is $50,000. But then after that, let's say we suddenly are going to add in business use of home, depreciation, mileage, and they do have a few other things that we occasionally can add back, like depletion and amortization, but we typically don't see those kind of things when we're doing, that stuff just doesn't typically show up on an LLC schedule. Yeah. But you can technically add those things back. And then when you have a scenario like when you're dealing with rental income, if we looked at a Schedule E as it relates to our last topic that we were discussing, when we have someone that's established with a bunch of properties, we have to remember that we can add back the mortgage interest, the property taxes. We can also add back in the insurance, and we use those all as offsets for how we determine how much someone actually earns. If you are a self-employed business owner and you are writing off a lot of miscellaneous expenses, like let's say you have a really expensive car, let's say you're taking the cost of repairs in lieu of mileage on your tax return. that might help you out at the end of the day if you have a really expensive vehicle, but adding back the mileage for us allows us to show more income for you from the standpoint of how we qualify people.
Got it.
So that's in a nutshell, that's what it looks like. But the other thing I was going to say about this is that we're having to look at income trends. So if we have a scenario where someone's been self-employed for, let's say, 2 or 3 years, but the income year over year has declined by 25% or more, the underwriter very often will just take a 12-month average of the most recent year instead of giving you credit for both years, unless there was some circumstance that had some merit for why the decline in income occurred. So it's really important to understand that when you're qualifying for self-employed income, we're planning on giving you a debt that's got to be paid on a timely manner for 15 to 30 years. And we have to basically measure the risk around that by considering the average of your income, whether it's increasing or declining.
Yeah, that makes sense. So for the people that are listening, I often get times where we're talking about mileage, we're talking about home office deduction. And as a tax accountant, my goal is let's get that net income or profit as absolutely low as possible. But for someone that's looking to buy a home, they're like, well, that might not be a good idea. Or maybe someone that's looking to sell their business, that's another story. But, my goal is always to lower that tax liability as much as possible. And so some people say, well, I don't want to do a home office because that's going to make my income look low and I'm looking to purchase a house in the next couple of years. Or I don't want to do a mileage deduction. So for those listening, what Bill is saying is that your net income, you pay taxes on the lower amount. But what they'll do is they'll add that back into your final number to get you up to a higher income level as a consideration point.
Absolutely, 100%. So I believe I'm able to add back 25 cents a mile right now towards qualifying for anyone that writes off mileage on their taxes.
Got it. Okay. Now, when it comes to, I know you mentioned self-employed individual for 2 to 3 years. How long does someone typically have to be self-employed in order to qualify for a mortgage? So I'm a W-2 guy. I quit my job and I started self-employed. I'm got a business for 2 months. Am I able to qualify for a mortgage right away, or how does that work?
It's a good segue into the next thing that's really, really relevant and sometimes a hot topic, especially when you have someone that's let's say pretty savvy about how they set out their plans. So let's use a dentist as an example. So I go and I get out of dental school and I decide to go work for someone within their practice and become a W-2 worker while I'm learning the ebbs and the flows of their practice and making sure that I'm ready for that next step, which is eventually to have my own practice one day. And let's say that I was in that dental practice for, let's say, at least a year or more. And I suddenly was given the opportunity to purchase this practice from an individual that, let's say, was close to retirement or something like that. Mm-hmm. The basics of it would be that they would need to have filed at least 1 year of self-employed tax returns under their new business to make sure that the income trend was going to support the path that it had previously been on in order for you to use that person's income for qualifying. So the common misconception that relates to how people view self-employed income in our industry is that you have to have a 2-year average for qualifying, and that simply isn't the case. We have instances where I've had a guy that was a mechanic that bought his own shop after he had worked somewhere for a while. He was able to do it after a year. I've had a dentist in the same scenario also able to do it after 1 year. The thing that we have to make sure on is their ability to manage their cash flow and the customer base has not deteriorated or haven't had any fluctuations where it would affect the likelihood of continuance of that income stream.
Mm-hmm.
Go ahead.
I was just going to follow up and say, when you're a business owner and you look to get a mortgage, does that process to get funding usually take a little bit longer than someone that's just a W-2 employee, or does that process kind of go just as quick?
It really does go just as fast. The scenario where, let's just say we had an instance where someone had not, let's say they had just filed their tax returns with the IRS. There are some instances where we're going to want to see some proof that those taxes were actually accepted by the IRS. There are some instances where some underwriters, and I say this as kind of like a generalization, but there's a document that we commonly request from customers called the 4506T transcript request form for the IRS. We will actually send in a transcript request form to make sure that the transcript supports the income that was presented on the tax returns that were given to us as the lender. So we'll want to authenticate that the IRS thinks that the income that was supported matches what we got on our side. So basically an example would be, let's say you got done with your taxes in January or February, and let's say we're waiting for those transcripts to become available. That would be one reason why someone might have a little bit longer process to get to the finish line. But that notwithstanding, if that wasn't the issue, it shouldn't take any more time than it otherwise would for a W-2 person.
Got it. I have to say, it's kind of weird when you submit a tax return and they're like, okay, thanks for this. We have to ask, talk to the IRS to ensure this is accurate information. Just off the side, how many times do you find that the IRS comes back or you get the transcript back and it doesn't match?
It has happened. It has happened a few times.
An attempt of fraud, or just someone that might have two versions of their tax return, they just pulled the wrong one?
Yeah, I just pulled the wrong version. I don't really know what to say there. Gosh, I really thought that was the version I turned into the IRS. The thing of it is that when people are going to get a mortgage, sometimes their motivations might not be congruent with what they would normally associate with their other decisions. The realities of this are that when I get pulled over for speeding, the police officer has probably heard just about every scenario as to why I shouldn't have been speeding or what my reasons are. And the mortgage lender has a lot of different means for verifying that everything is congruent with what's being reported to us too. There's all kinds of different alerts and cross checks that have to happen in the industry to prevent that F word, which is fraud.
Yeah, no, that's funny. And just to go back, as we kind of finalize some of this discussion on the self-employed side, what are the differences? You mentioned some of the add backs on the Schedule C, but what are the differences if you're coming in and you have an S corporation or a C corporation or something like that, and you're taking or you qualifying someone that owns that piece instead of a Schedule C business?
Yeah, it's good that you brought that back up because we didn't finish that thought. So basically, let's say you have an S corp or a C corp. In the case where we have someone that's got the K1, so we're going to take the K1 income. If you are, based on what you're W-2ing yourself for, we're going to also bring in that income as well. We're also going to bring in depreciation. We're going to have to subtract, and this is the one thing I talked about the additions before because I was kind of turning it in the positive spin, but I didn't talk about some of the common things we have to deduct. So meals and entertainment and travel are definite deductions that I have to take away from my income, and then also on the case of the corporate tax returns, I also have to deduct notes payable in less than 1 year. And that's a really big one in our industry, that if the lender misses that one, that could make or break the approval of a loan. So if you go into the tax return and you look under the section for notes payable less than 1 year, if you have anything like that and it's documented in your return, they have to subtract that from your net income. And that could make or break the ability to approve a loan.
Got it. And yeah, that's key. I think a lot of times, especially on the S Corp side, they'll have shareholder loans that often come in there, and that, I would assume plays a role in that.
Yep.
Awesome. So, to touch on a few other things when it comes to actually getting funding and qualifying for a loan, I want to talk about credit reports and things like that. So when can a credit score affect the interest rate that you're going to get on a loan?
So to begin with that topic, and that is something that's really taken on a completely different perspective than it had 10 years ago. Mm-hmm. Because when you think about the fact that we have three major credit bureaus, we have Equifax, Experian, and TransUnion. And within that, we have multiple different types of credit reports that exist out there in the marketplace. We have to remember that these credit reports are essentially at the root, they're actual businesses that are basically compiling data and trying to sell a lot of their intelligence to creditors and consider the method of what they're doing to be a basis for how people decide to lend. And if they're doing that, they're looking for any ways that they can make money and make revenue for their business as to how they practice with what they're offering consumers and creditors. So what I mean by that really is that, so now you can get your credit score from your credit card. You can get your credit score, by going to places like Credit Karma and myfico.com. And there are several other places that you can go to get a credit report now. In fact, a lot of people just go to, they'll go to annualcreditreport.com to get a free copy of their credit report. But if they go to that place to get the free copy of the report, they're not going to receive their score. So let's take an example where we look at credit reports and figure out and assess how they affect the interest rate. And to answer that question, we have to look at the algorithms that are being used by the credit bureaus to determine the credit score in the first place. So within the algorithms, we have proportion of balances to limits. So that's going to be a measure like, in other words, have you maxed out all your credit cards? Mm-hmm. Late payments, collections, whether they be for medical or for non-medical obligations. And then, of course, the one that has the biggest misconception is inquiries. So everyone thinks that when I go and get my credit checked, that I shouldn't go and get it checked anywhere else because my score is going to drop. When in reality, the Consumer Financial Protection Bureau says that you have 45 days to shop for a mortgage where those inquiries should not affect your rating, because you should not be penalized for shopping for credit as it relates to a mortgage or an installment debt. Now, when that's for a credit card, that's a whole different story because that's going to be one for one. But if it's for an auto loan or a mortgage, you should not be penalized for going about your business to try and figure out who's going to give you the best terms.
Interesting.
Now, as it relates to the credit scores in the industry, and it's been this way for quite some time, they have, I used that term earlier in our recording today, called loan level price adjuster. So if you have a credit score that's below 740, there's an adjuster, and it goes down in 20-point increments all the way down to 620 is the lowest credit score allowed for a conventional loan today. And in that scenario, your interest rate goes up proportional from a risk perspective for how much your credit score goes down.
So if your credit score goes up, let's say you're above that, did you say 720 or 740? 740. If you're above that 740, let's say you're at 850, does that change anything? Or is that just once you hit that 740 mark, you're just kind of locked in at that?
It does for mortgage insurance, but it does not for your interest rate. Once the powers that be have deemed the highest credit score for determining an interest rate to be 740.
Okay. So for someone that might be at that 700 level or that 720, where they're close to that 740, or trying to somehow impact or increase their credit score, what are some ways that things that people can do to raise their credit score?
So there are a few real easy ways that you can do that. And the one that I always tell people to do right away is to go out to, and I think you and I touched on this one other time in conversation. It's called optoutprescreen.com. OPT, optoutprescreen.com. So if you go there and you put in your information, you're going to limit yourself from receiving any type of solicitations behind the scenes where the credit bureaus are going in and providing information to credit card companies to see if they should, solicit you for a credit card or a loan. Believe it or not, that stuff does have a bearing on your rating, even though you don't even know it's happening. The second thing that you can do is make sure that you keep the balance on credit cards at or below 30% of your available credit limit. And then the final thing is to make sure that if you had any past medical collections, if you had any scenarios where medical bill maybe got missed and it ended up on your credit report, to make sure that you ask that collection agency as a part of settling the bill that they will delete it from your credit report completely, because if you don't ask, they don't feel any sense of obligation to do that for you. Those are the easiest ways to raise your credit score. Beyond that, making sure that you're not making any late payments, making sure that you just try to keep an eye on those balance to limit ratios on that revolving debt. Those are really my best practices.
Yeah, no, that's great. And so, you mentioned if you have a late payment on, say, a medical or something like that, what if you see something on your credit report that you think is incorrect? And so if you try to dispute something that's on your credit report, what does that process look like, and what impact does that have on your credit when you're disputing an item?
Yeah, that's a good question. So when we have scenarios where we see someone that has put a dispute on their credit report, they're basically saying that for a 90-day period, they want that derogatory piece of credit to be excluded from how their credit score is calculated. They're basically saying that I don't agree with this charge or this late payment or this collection, and I want an opportunity to research the validity of this item. And if the creditor comes back and responds that they feel that you are in fact liable for that item, when that dispute gets removed, your credit score goes back to what it was before that dispute got filed. So sometimes people will take this path of least resistance mentality that says, oh, I got this bad piece of delinquent credit on my report, and I want to limit the effect that that's having on my rating. So they file the dispute, and then that's all they do. They don't even do anything else about it. So as soon as the creditor goes and responds and says, no, that person did in fact owe that money, or they were in fact obligated for that derogatory item, that's at the end of the day, that was just a short-term solution to what could be a long-term problem.
Mm-hmm.
So I always tell people, if you're going to dispute something, bring some merit behind why you're disputing it. Don't just dispute it just because someone said, oh, then go and that'll solve it. Just dispute that. That's the way to, handle it. It's not, because really those dispute markings actually affect how creditors approve and make credit decisions, because if someone disputes too many things on a credit report, they consider that to be misleading in the way that they're determining a credit decision. So in other words, let's say you disputed 3 or 4 items on your credit report and those disputes were filed. The creditor's underwriter will probably say something like, I can't be completely certain the impact that these items have had on your credit report, Mike. So what I'm going to make you do is delete those disputes, remove those disputes from your credit report before I can finish the credit decision. And that's common in the mortgage industry now. If there are too many disputes on a credit report, they will make the consumer remove those disputes before they can finish their credit decision.
Interesting. Yeah, I mean, like you mentioned, it's just a temporary fix to a problem that's, you have to take that extra step to really kind of resolve whatever issue it might be that you're disputing.
I will tell you, the number one thing that anyone should dispute on a credit report is any derogatory credit from a company that went out of business. Because if you were in a scenario where you filed a dispute to the credit bureau and the creditor does not respond in 30 days, did you know that item will be deleted off your credit report, no questions asked?
Interesting.
That's pretty cool.
Yeah.
You have instances where we will tell people to go file disputes even when the creditor said, like a medical collection. A lot of times they won't tell you that let's say I owed you money for a medical bill, Mike, and I didn't, and you said, I'm sorry, I'm not going to remove that dispute. There have been a lot of occasions where after a payment was made, at the end of the day, they still cooperated with a deletion request so long as that they were paid. Because with these medical collections, for example, they just want to get their payment. After that, they're not trying to go after the people, sell them anymore.
Mm-hmm. No, that's great to know. And knowing that, if you do make a mishap, and especially on the medical side, I think that's, one way that it can, the bills can slip through the crack, or you're disputing the bill initially, and then it's been left outstanding for so long. Now it becomes delinquent and they're reporting it. But it's good to know that you can get those, or dispute that, talk to the creditor and see if you can get that removed from your report.
They make it really easy for consumers now. Usually you just need to go to the same page that you would go to file a credit freeze. If you were going to freeze your credit report where you want to lock it down because you're afraid of there being some fraud that might possibly occur against you, the same place you go to file a credit freeze, you can go to file a credit dispute. And then if you have anything in writing that's got merit behind it regarding, your position that you did pay something back, or there's something on there that doesn't belong to you, something that's erroneous, you do have the ability to upload that documentation so that it gets considered by the credit bureau.
Awesome. Well, yeah, I think that the information we discussed here today is extremely helpful. I know I get asked so many times with new business owners, especially business owners that really haven't been in business that long, I'm looking to buy a house. I want to do this. I want to do that. And I'm afraid that these deductions that you're paying, that you're telling me to take, are going to hurt me in the long run. And so, it's good to know, give some insights on, what does a lender look at, or what's a lender actually looking at when they apply, they're self-employed and they're applying for loans, and it's not always a bad thing. So
Yeah.
this is going to be great information for our audience. To just kind of finalize, wrap things up, if there's anything else that you want to share, feel free to do so, and also give some information on how people can reach out to you if they have additional questions, want to contact you further, any kind of websites or anything. And I'll also put those links in the show notes so someone can find them there too.
Yeah, thanks for saying that, Mike. I do have a couple things that I just want to touch on quickly as it relates to someone going into business for themselves. A lot of times when you go through this process, it happens where you get too far into the business, or too far into the basis for how you're going to manage your cash flow and your accounting, before you realize that, oh man, we really did want to eventually get qualified to buy a home. So keep in mind that if you have a spouse that's not tied into your business, we can do mortgages based on W-2 transcripts instead of using actual tax returns. So if we were in a situation where we had someone that, let's say, had a spouse that made a decent amount of income on the W-2 side, we would be able to exclude, even if it had a loss, we would be able to exclude business tax returns from how someone qualifies to purchase or get pre-approved to buy something. And then keep in mind too, there are occasions where if you're setting out to determine, like I had an instance where a client came to me and said, hey, I just filed these tax returns. I know I'm not going to be able to qualify this year. Can you show me where we'll need to be based on our current situation and what we want to buy, for how much income we need to be able to show next year? And to try and think about it in that framework, because people often are very reactive instead of proactive when it comes to the planning that could easily create more of a predictable outcome for that situation.
Mm-hmm. Yeah,
if you wanted to get in touch with me so that we can go through any type of pre-qualification scenarios, or discuss any opportunities to learn more about how you can do financing, you can find me at www.billthebanker.com.
Awesome. Well, thanks, Bill, for jumping on. Like I said to our audience, I've known Bill for quite some time, and he's definitely an anomaly in the space. He's an incredible guy, and you can just tell that by the work he does, and the way he helps out other people, the information he shares. So I've got nothing but great things to say.
Thanks, Mike.
Awesome.